Buy the best stock in the market if you want to outperform. So in today's video, I'll be covering a few things. We'll be covering how to buy the best stocks in the market, your healthcare insurance stocks crashing, as well as some questions left in the comment section below. So let's talk about how to buy the best stocks first. And when it comes to earnings, these are the few things that your management can do. So your management, they can go through acquisitions, they can reinvest into the business itself, they can give out dividends or do buybacks as well. So for acquisitions, they're normally unpredictable, but the CEOs, they love that because they want to leave the company with the high profile deal that is being made, and they will also need to meet the expectation of Wall Street, so they acquire to increase the growth of the company itself. But this is bad because number one, the company could overpay for the acquired business, and number two, that money, the money that they used to acquire another business, could have been used for buybacks as well as dividends, which is much more shareholder friendly as well. So for example, a company like Salesforce has been actively pursuing acquisitions. So Salesforce back in the day, they bought a company called Slack. So Slack is a competitor to Microsoft Teams. It is similar to Discord in terms of the interface itself. And for Slack, they actually paid a 24 times forward revenue. So they massively overpaid for Slack. And so far, the Slack investment hasn't really paid off yet for Salesforce. It is still massively lagging behind Microsoft Teams. And they haven't been able to steal market share from Microsoft as well. So for our stocks, beware when the management does a lot of acquisitions, because for acquisitions, they're normally extremely unpredictable. So the best way to use the capital by the management itself is to reinvest into the business, is to do dividends or do buybacks as well. So a management can reinvest into the business when the returns on capital is high. So when you have high ROIC for a prolonged period of time, when you have high ROIC as well, meaning to say if you invest more capital into the business itself, you'll be able to generate incremental earnings on those additional amounts of invested capital. This is normally the best case for your businesses. You want to find businesses that can continually reinvest their earnings into the business to continue growing itself. So for example, a company like Ford has ROIC of 0.4%, so meaning to say the management shouldn't be reinvesting any of its earnings to the business itself, because when they do that, it is shareholder destroying. Instead, what they should be doing is to give it out as dividends or to simply just do buybacks itself. So the best companies to own are the ones with high reinvestment rate as well as high ROIC, leading to high ROIIC, which is your returns on incremental invested capital. So for example, Google and Amazon, they currently have high capex, but despite their high capex, they're still able to maintain high levels of ROIC, meaning to say those capex, they're paying off right now, and that's why you're seeing ROIIC of upwards of 20% for these two hyperscalers here, and that is the positive thing about these two hyperscalers, which is why you should be investing into them. Next way, a management can return capital is through dividends. So dividends are usually given out by companies that are maturing because there's no other way to reinvest into the business itself. And when you're picking your dividend stocks, make sure to pick the ones that increase their dividends above the rates of inflation so that you can beat inflation. And these are called your dividend compounding machines. So here are two of the best dividend companies that are neglected by Wall Street, which are high quality as well. So the first one is Ultra and the second one is American Towers. So let's talk about Ultra first. Ultra owns your Marlboro and they own a portion of Philip Morris as well. And for Ultra, the Marlboro brand has around 40% of the retail market share in the US itself, which shows that it has a dominant share there. And for Ultra, the company has been able to increase their dividends at above levels of inflation. And the dividend yield is quite high as well, so it's around 7%. So if you can get 7% dividend yield for Ultra, along with some capital gains, you can easily beat the market with a company like Ultra, which is unconventional compared to the tech stocks that everyone chooses. And then the other company is American Towers as well. So for American Towers, they own all these cellular towers over here, and they basically have a geographical monopoly wherever that cellular tower is, because it doesn't make sense for another company to come in and build a cellular tower there when American Tower already has them there. And for American Towers, they're basically the biggest company in terms of your cellular towers, and it sort of acts like a REIT as well, with recurring streams of revenue coming in every single year for this business, with long-term leases that are easily renewable. So for American Towers, it's actually one of Chuck Akre's best investments. It is a quality company, a predictable one as well, giving out a decent dividend yield as well, which is around 3% currently. So the last way that the management can return capital back to its shareholders is through buybacks. So buybacks can help to increase the earnings per share of the company because you're decreasing the denominator itself, which is the number of shares outstanding, thereby increasing the EPS of the company itself. So buybacks are usually the best way to return capital to shareholder because you don't have to pay the dividend withholding tax that the US government wants, and 100% of the capital will be returned to its shareholders itself. So for example, a company like AutoZone, the entire thesis of this company is just buybacks and buybacks almost every single year. It has a stable underlying business which is growing moderately at around 5-6%. And if you're to add the buybacks of this company has been able to increase their EPS by upwards of 11, 13% over the past 5-10 years or so. So for AutoZone, it is a company with a very simple thesis and it has crushed the S&P 500. So over the past 10 years, the stock is up around 444% versus the S&P 500, which is up around 200%. But take note, there are scenarios where your buybacks are bad. So buying back stock to mask underlying slow organic growth of the business is bad for the company. So for example, a company could have revenue growth of 2% and EPS growth of around 10%. That is usually a bad sign for the company. So make sure to only buy strong companies that do buybacks as well, because the underlying business quality is important as well. So another possible bad scenario is when your companies, they buy back a lot of shares when the shares are expensive. So for example, a company like FICO has been buying back shares almost every single year for the past 3 years already, despite the multiple trading at upwards of 60, 70 times earnings. And during that time period as well, the leverage of the company has increased massively. So this is usually a bad sign for the company because it's like overpaying for a business. You never want to overpay for any business. Next portion, I'll be talking about healthcare insurance stocks that have been crashing over the past few days. So this company, Canteen, they withdrew their EPS guidance and they'll be reporting more on it on the 23rd of July. And this has sent the stock dropping by around 40% in one single day. So what exactly happened and what does this mean for the broader healthcare insurance space? So this is a summary that I found on X. So it says Canteen withdrew 2025 GAAP and adjusted diluted EPS guidance. So for example, they had a net risk adjustment revenue reduction of around $2.75 on the EPS. So they actually dropped their EPS by around 40%, and that's why you're seeing the stock dropping 40% in one single day. They had additional reductions expected for remaining 7 states. They are planning to refile 2026 market rates to address these issues. And for the Medicaid side, they are experiencing increased cost, and the Medicaid health benefit ratio is expected to exceed Q1. So this is bad for their business as well, the Medicaid business. And for the Medicare portion, it's a positive. So they actually said that the Medicare Advantage portion is outperforming expectation, and there's been strong expense management. So what does this mean for a company like United Health, for example? So United Health, in response to the news, is down around 4%. So for United Health, if you're to look into their revenue itself, only about 15% actually comes from Medicaid, the portion where Canteen actually complained about. So for United Health, I see this company as extremely cheap now, and the worst is probably already priced in, and that's why you're only seeing the stock dropping 3% in this single day itself. But if you're buying into all these insurance stocks, you should understand the risk when it comes to your insurance companies, because typically they're bad companies to invest in. And this is what Warren Buffett actually said in his 2024 annual report as well. So he said, in long tail lines, a property and casualty insurer may report large but fictitious profits to its owners and regulators for many years, even decades. The accounting can be particularly dangerous if the CEO is an optimist or crook. These possibilities are not fanciful. History reveals a large number of each species. So for your healthcare insurance companies, they have the ability to mask their bad earnings. They have the ability to inflate their earnings as well, which is what the old CEO of United Health did when he was in charge. So what he did was he inflated the revenue of the company, and now the company is experiencing lower margins and lower profit because of him bringing in all the low quality patients that United Health currently serves. So for insurance companies, they're typically extremely risky, and that's why I think it is a bad industry to invest in. But for United Health, it's a special case because the company is extremely undervalued today. And for United Health, this is what I'm doing with my stake in the company. I'm probably just holding on to the business. It's cheap, and the stock has already had the worst case being priced in. It is down around 50% since its pre-earnings itself, and it's the best of the bad bunch in the healthcare industry. So it was always seen as a safe haven, a quality compounder. So I don't think I'll be selling out of United Health. It is a quality company fundamentally experiencing some form of headwind, which is industry-wide. So I'll be holding on to this one and we'll see how that one plays out. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says, what are your thoughts on Oscar Health? So Oscar Health is actually down around 15% today as well because of the Canteen news. And for Oscar Health, I see it as a speculative stock. I think the best insurance company to own is simply just to own United Health. And for Oscar, it is a stock that is being chased up by retail investors, which is what I typically avoid as well. Next question, it says, why focus on free cash flow more than operating cash flow? Just curious. So your free cash flow is derived from operating cash flow minus capex, and capex is a real expense for the company as well. So for capex, your maintenance capex as well as your growth capex, for a lot of the companies that have depressed free cash flow is because they invest a lot of their money into growing capex. So when a company is investing a lot into their growing capex portion, it is important that the company is able to return their invested capital into capex itself. So why exactly should an investor focus on free cash flow instead of operating cash flow? Because free cash flow is simply the money that you're taking out of the business. If a company is furiously reinvesting into the business with no tangible return, that is bad for the company. And as Buffett says, the single measure of the intrinsic value of a company is by the amount of cash they generate from today until terminal date. So the metric is the free cash flow, which is the money that you're taking out of the business, because your free cash flow can be used to buy back shares, it can be used to give out dividends, it can be used to pay down the debt as well. And so an investor should pay more attention to the free cash flow instead of the operating cash flow, because capex is real expense as well. It will come back to hurt the company in the future, especially when there's depreciation and amortization and so on. So why focus on free cash flow instead of capex? Because it is the real cash that you can take out of the business itself. Your operating cash flow does not directly account the capex that the company is spending, which is the money that you won't be able to take out of the business. I hope you guys have found this one useful and invest safe.